So welcome everyone to essentially the first intro to DeFi event that Oxford Blockchain are hosting this year. Last week, Anthony gave us a great introduction to blockchain as a whole with Oxford Women in Business, and now we're lucky enough to have Dr. Michael Bentley, Oxford alum or alumnus himself, with an amazing background in evolutionary biology and the mathematical modeling of that. Former postdoc from Oxford as well, but now he's turned fully into a crypto researcher, but also a crypto spin-out company known as Euler XYZ, famously won Encode's hackathon last summer, Encode Club's last hackathon. Those of you at our previous event, you may remember that Encode Club run amazing hackathons that I all encourage essentially anyone here to join, whether you're a developer or not. And I'm sure there'll be, we have information on them. But first of all, thank you to Michael for giving us this amazing event. Please hold questions to the end. And Michael will first present his slides, and then we'll have a Q&A session. But once again, yeah, thanks, Michael. And all over to you for the intro to DeFi. I think it's a perfect time for this event, given what's going on in the markets at the moment. So yeah, thank you.
Fantastic. Yeah, very exciting time for everybody right now, as you said. So yeah, and thank you very much for the kind introduction. So I'm Michael Bentley, and I'm from Euler XYZ. At Euler, we're building software that helps people to earn interest on all of their crypto assets without the need for a trusted third party like a bank. And today I'm going to show you why I think decentralized finance, otherwise known as DeFi, is helping to create a fairer financial system. So here's how I'll do that. First, I'm going to remind you a little bit about some of the bad behavior that goes on in the traditional finance world. I'm going to draw on experiences from my own career. Next, I'll give you an overview about some of the most important protocols in DeFi right now. I'll explain to you how they work and how they're helping reduce the need for trusted third parties in finance. Finally, I'm going to end by plugging the protocol that we're developing at Euler. Specifically, I'm going to show you how one of our innovations that we've introduced is helping to bring permissionless lending to the long tail of the crypto market. So let me start by reminding you about why people are getting tired of the way things are done in the traditional finance world. As Brandon said, I was previously a postdoc at Oxford, and I've spent the last 10 years in academia, more or less. But when I first finished my undergraduate degree in 2008, I had two fairly unpleasant experiences working in the traditional finance world, which I think will help highlight some of the issues that traditional finance has. So the first one, I landed a temporary job in a factory in Leeds, actually, opening letters on behalf of HSBC. I was helping to open a pile of 3 million of these letters that were mostly from angry customers who had been retrospectively asked if they were enjoying a new service that HSBC were providing. And what this was that, back then checks used to take 5 or 7 days to clear, and bank payments were not as reliable as they are today. So sometimes you wouldn't have enough money in your bank when the bills came out. And rather than reject bills when your bank account was empty, HSBC started offering a compulsory service where they would open an involuntary overdraft on your behalf and charge you £25 every time you used it. So for many customers, this could spiral quite quickly into hundreds of pounds worth of debt as the sort of payment, the charges kept accruing day after day. And I know this because this happened to me when I was a student. So these so-called service charges were a great source of revenue for HSBC, helping them to record profits that were record levels back in 2008. And I was day after day was opening these letters, reminding me about this bad behaviour. The second example is from it was straight after this job. I actually got a proper job working as an analyst for RBS. Now, at the time, they were run by a really nice guy called Fred the Shred Goodwin, who was Forbes Businessman of the Year in 2002, and then later knighted in 2004. And I'll never forget my first day in this job. So as I walked into the office, my new boss came over to me and said that I didn't need to panic because my job was still being kept on. So I had absolutely no idea what he was talking about, but it turned out that my first day was pretty much right at the start of a massive crisis for RBS that would leave them requiring $45 billion public bailout just a few months later. Many of the people in the office that day and for the days that followed were absolutely distraught. I saw several colleagues cry and many very angry. And part of the reason for this is that many of the staff had actually been persuaded by RBS to use their salaries and funds to buy new shares in the company in only April of that year, when the company raised £12 billion in private financing to help cover losses that they'd made. Of course, yeah, as you can see there, like, it wasn't long before the share price completely collapsed and left ordinary people holding the bag, so to speak. So the take-home message from those examples is that, you know, with banks, you aren't really in control of your own finance, and when there's often a massive lack of transparency in the current financial system that often hurts ordinary people. So now I'm going to tell you a little bit about DeFi, where trustlessness and transparency are actually enshrined in smart contract code. So the idea behind decentralized finance is that financial institutions can be replaced by smart contracts that are run on censorship-resistant blockchains. Now, anyone can access these new protocols free of gaining permission or having to show trust, or in fact to be trusted. If we think about this, you know, trying to force a smart contract to put users into debt without the permission, like the HSBC example I gave before, you know, that you just can't do this. Your transactions would fail. Similarly, you know, try persuading people that your lending protocol doesn't hold all this risky debt, like the RBS example I gave. You know, in that system, everything's visible on the blockchain, so you just wouldn't get away with it. So yeah, given the many potential advantages of DeFi, it's not surprising that it's seen this meteoric rise that we alluded to at the start of the presentation. And there's a huge amount of capital now locked in DeFi protocols that has mostly come on board over the past year. Generally, using DeFi, you can store your funds as a hedge against inflation in a local currency. You can protect them from authoritarian institutions and governments. You can transfer funds across the world with low cost and with a much shorter time frame than it would take using a normal bank. You can trade assets freely and invest where you see fit without needing special licenses or having to go through intermediaries that are often rent seekers. And generally, you can earn interest on your assets and pull them in and out of savings account as you see fit, without paperwork or permission. So I think it's important to stress in this talk that I'm not claiming that DeFi is some kind of panacea for all of the problems in finance. Indeed, it comes with lots of challenges too. But the reason I think we're seeing an exponential growth in this sector is because of all the aforementioned advantages. And I don't think we're going to see this growth slow anytime soon. This is just a roadmap of sort of DeFi that was actually now quite out of date. But you can see all the different sectors where there's an array of different DeFi protocols in existence already. So we've got currencies, trades, lending and borrowing, derivatives, investment, insurance, protocols dealing with synthetic assets. And the important thing here is that these all exist in one place, all on the Ethereum blockchain for the most part, which means that they can all interact with one another as kind of money Legos, which we'll come to later. So yeah, we've now covered some of the issues with traditional finance and seen why DeFi is a potential alternative. So I thought what I'd do now is just go through some case studies, 4 different case studies where I think some of the most important innovations in DeFi have already happened. After this, I'll then give you a good picture of why DeFi works well in practice, not just as an idea, and tell you a bit more about what we're bringing to the party, so to speak, with Euler. So the first case study on my list is Maker Protocol. So Maker is a set of smart contracts for producing a stablecoin asset called DAI. Now, DAI is pegged to the US dollar. So why is this important? Well, it provides a stable censorship resistant form of money. It connects DeFi to everyday finance. You can deposit your crypto assets, withdraw DAI, or use it, sell it, and then access funds from the ordinary world, whilst leaving your crypto assets locked in a DeFi protocol. And importantly, it allows people without access to a bank account to access a stable form of money. So just to stress why this is important, it's worth remembering that most of the people around the world are not like people who are living in the UK, where we can generally more or less trust our government not to freeze our bank accounts. And generally, the central bank in the UK does a reasonable job of managing the money. But this isn't true for lots of parts of the world. A couple of high-profile examples for these recently are the pro-democracy protests in Hong Kong, which have seen institutions crack down on people's bank accounts who they believe were involved in the protests, and obviously the high-profile case of what happened in Venezuela with the hyperinflation there. So how does Maker work? Well, generally, what happens is you have other crypto assets which you've acquired, and you bring them to the Maker smart contracts, and you deposit them into what's called a collateralized debt position, a type of smart contract where, it's going to hold these other crypto assets for you. So generally, these are over-collateralized loans of DAI. So you would bring in this example here, $150 worth of Ethereum. You would then put that into these CDPs. Maker would then spit out $100 worth of DAI for you, which you could then go and use as you see fit. And importantly, you can then loan DAI to other people and earn interest on it. That's called the DAI savings rate. But you can also go and use it for trading however you see fit. And there's currently $1.7 billion worth of DAI in circulation, which shows just how popular this has been. My next case study is Uniswap. So Uniswap is a permissionless, decentralized exchange that allows anybody to list any asset that they like and then trade those assets. And unlike the traditional finance world, which tends to rely on order book approach, Uniswap uses what's called a constant product formula instead of an order book. So it replaces trading with a kind of algorithm. The important thing here is that anyone can trade these assets without permission or the risk of the market being shut down. Users can create their own markets. And on centralized exchanges, a lot of the markets actually use market makers to help provide liquidity on both sides of the markets. And these market makers are intermediaries that are supposed to be agnostic about which side of the market they're on, but in practice, they often use their use things to trading to their advantage, to make it, which ends up making it difficult for ordinary users to manage their assets. And they're also sucking profits out of systems because they're basically profiting from the spread between the highest bid and the lowest ask on a protocol. Fortunately, on Uniswap, if you go to Uniswap, the way in which it works allows profit from market making to flow directly to users who hold underlying assets. So again, we've managed to cut out one of these intermediaries. Now, I just want to give this as a quick example that's really relevant recently about why we shouldn't trust centralized trading exchanges. So famously, there's been a massive trade gone wrong, so to speak, in the traditional markets recently with GameStop. So they were facing a hedge fund who were called Melvin Capital, who had taken on an awful amount of leverage to borrow and then sell GameStop shares, effectively making a bet that its stock price would decrease. So they're taking a huge short position. And they were facing huge losses if the price of GameStop stock was to rise, which of course it duly did when retail investors from Reddit decided to basically go against Melvin Capital and start buying up the stock. But what happened next was actually really important here. So a lot of this trading from the retail side was taking place on Robinhood, and Robinhood, back in 2016, they had this thing on Twitter, which was very popular. It said, let the people trade. This is what Robinhood stands for. But of course, when all this furore happened with GameStop, suddenly, for whatever reason, Robinhood decided that users were no longer fit to trade themselves, and they actually shut down the buy side of the market for these stocks. And ultimately, the effect of that was to massively hurt retail investors and to massively benefit these hedge funds who could cover their positions at a much cheaper rate than they were otherwise facing. So that interest should be going to holders of the stock, which in this case should have been those Reddit users that were buying up the stock. But in fact, Robinhood has been basically sucking in all that revenue. So all that interest that Melvin Capital and others were paying was actually going to Robinhood rather than users. So again, we've got a great example of an intermediary sucking finance away from ordinary people. So generally, just briefly, how Uniswap works. If you go to their website, you can act as a liquidity provider, which means that you're going to provide assets from two sides of the market. So you might want to earn some revenue from other people trading by depositing liquidity into one of these pools. So typically, you might bring on board, say, some Ethereum and some Link tokens. You would deposit those to both sides of the pool. Then other people making swaps basically purchase assets from that pool, and as they do so, you earn fees from their trades. And the reserves in the pool might change; they might go up or down. But overall, the value in both sides of the pool stays the same. And at a later date, you can come and withdraw your assets from the pool and take out all those fees that you've accrued in the meantime. So it's a very fair system for traders, and it avoids the need for these order books and market makers. Yeah, my next example is Compound Finance. These guys are offering permissionless money markets, which means lending and borrowing of assets to users. And how they've done things is they've replaced the order book approach for defining what interest you might need to pay on your assets, which is ordinarily either determined by banks or some kind of centralized intermediary who's determining what interest rates people should pay. Here they've replaced that with an algorithm that determines the interest rate. And the great thing about this is that when you go onto Compound, users can enter or exit markets at any time. So you can go and deposit your assets immediately now and start earning interest on those. Similarly, you can go straight away and borrow something that you need completely without permission, and no one will ever be able to stop you. One of the useful features of this, of course, is that by borrowing assets and lending them out, you can take leverage positions on them and take long and short positions on the market. So briefly, how this works, if we look at this sort of graph here, if you imagine a pool of people's assets, then that people have deposited in order to lend out to others, then as I don't know if my cursor works here, if there's no borrowing from this pool, then we say it's not utilized at all, and when it's not utilized, you get a very low interest rate. But as borrowing from the pool goes up, the algorithm determines that the interest rate goes up linearly with the amount of borrowing from the pool. So if there was 10 million lent and there was 5 million out in borrows, then it would be 50% utilized, and we'd have an interest rate around here. If it was fully utilized, then we'd have a much higher interest rate, and if it was not utilized at all, we'd have a very low interest rate. So it's a very clever and simple algorithm that works very, very effectively, and has allowed Compound to get to $6 billion worth of assets on its protocol as of late. My final case study is Yearn or Yearn. People say this differently depending where they're from. These guys are offering a yield aggregator, and this really replaces the kind of centralized intermediaries you have in the traditional financial markets that go away and try to manage your money and earn you some yield on your investments. And again, they use algorithms to dynamically allocate liquidity rather than using rather than having to trust a person. You can put your trust in an algorithm that will go away and run the calculations on the blockchain and do this in an optimized way. And this is really useful because when you use something like this, when you use an aggregator like this, you can pull your assets with other people, which ends up reducing fees for everybody. So it overall increases capital efficiency of investing. They offer different strategies for different investment strategies. So anybody can come and create one of these and put it on the protocol, and you can then choose to use it. And what this means is that there's all these strategies competing with one another all of the time, and we get a kind of natural selection among strategies. Which is the best one always tends to win out over a given period of time. And the Yearn guys are really taking advantage of this common feature in DeFi, where every protocol is composable with every other protocol. So this is sometimes being referred to as money Legos. So you can seamlessly put building blocks together where you can go and lend to one protocol, borrow from another, and it all links together in one sort of seamless transaction on the blockchain without you needing to get permission from multiple centralized intermediaries. So here's an example of how that might work. You, as a user, bring on board some Ethereum, and you put it in one of these strategies. So this is the current strategy available at the moment. These get way more complicated, by the way. But right now, this person here is depositing some Ethereum to this strategy, and the strategy itself works out that it's going to go away. First, it's going to mint some DAI. It's then going to deposit that DAI into a different vault. It'll then use that vault to interact with another protocol called Curve. Mint some other tokens, use those to earn fees from trading and lending and borrowing, and from yield farming. And ultimately what happens is, we end up with the user getting back more Ethereum than they put in through a complex investment strategy. Importantly, this is something that you probably, some people figure out by themselves, but for most ordinary users, this is a lot to manage. Whereas in Yearn, you can go and do this without needing to get into the weeds of all the details. So they're my four case studies. Now I want to tell you, give a plug to our protocol, Euler. We've seen a handful of examples about how DeFi is changing the nature of finance. And I want to tell you now about how Euler is helping people to earn interest on a much broader range of crypto assets. So Euler is a permissionless lending protocol, very similar to in sort of build to compound, but we've built this for the long tail of the market. There are many crypto assets out there at the moment that people can't earn interest on, that are just sat in people's wallets, not really being put to work. On Compound right now, you can lend and borrow up to 10 different assets. And we're trying to open up the space, open up the long tail of the market to allow people to lend and borrow any kind of asset. So as Brandon mentioned earlier, where did we come from? Well, we're quite new. We emerged from a Spark University hackathon run by, in conjunction with Encode and the Oxford Blockchain Society. That was just last September. We won the top prize in the hackathon, beating over 100 other teams from around the world, and we were then able to turn our idea and our hackathon project into a business proposal, and we've ended up being backed by top investors from around the world in a seed round that was led by Lemniscap. Now, there are many different innovations that we've introduced on Euler to allow people to access lending for the long tail, but today I'm going to tell you briefly just about one of those innovations that a lot of people seem to find pretty cool. But just briefly, there are, on Euler, we have permissionless creation of money markets, which means that, kind of like Uniswap, anybody can come and create a pool for lending and borrowing without needing any permission, and immediately start earning interest on any kind of asset. We use a novel kind of Oracle solution on Euler, for those of you that know what Oracles are. And most of our innovations are actually around how we manage risk for long tail assets. So on Compound, they're focusing mainly on things that are very liquid, and that have lots of trades going on every day. And these long tail of assets tend to have much less liquidity, which leads to higher volatility, which leads to higher risk. And so many of our other innovations are focused around how we can handle such large risk in a decentralized, permissionless way. But let me tell you about our main, one of our more exciting innovations. So to do this, I want to first tell you about how Compound works. And then I'm going to show you just how creative you can become when developing DeFi protocols. and how you can bring together different ideas from very different fields to optimize and change how finance works. In my case, I'm going to tell you about how control theory, which I learned about mainly in the context of evolutionary biology, can help determine an algorithm for autonomous interest rates. But first, let me tell you about compound and how they work in more detail. So on the left-hand side of this GIF here, what I'm showing you again is how the lending pools work on compound. So generally, you have a pool full of assets. Let's say you have a pool with $10 million worth of Ethereum in it, and people can borrow from this pool. And as they do so, the pool becomes utilized, which means that some fraction of the pool is actually out in lending. So when it's 50% out in lending, we have a 50% utilization ratio, and the interest rate is at this point on the interest rate curve. Now, what I'm showing here is that the interest rate depicted as this black dot ends up floating around over time as supply and demand changes for borrowing from this liquidity pool. So you get this, changing cyclical stuff with interest rates. So the interest rate goes up and down over time as supply and demand for borrowing changes. And what you see is that similarly the utilization changes in this sort of cyclical pattern. Now, this works really, really well for liquid assets, and has been extremely successful for Compound and other protocols like Aave. But it does face some challenges, particularly for long tail assets when the market is very volatile. And the reason for this is that a key parameter in this protocol is the slope of this curve. If you make the slope of this, the slope of this line here very shallow, then what that means is that the cost of borrowing increases very slowly with respect to utilization. And if the demand for borrowing is very high, then you can end up with a fully utilized pool. So this is actually really bad for the protocol as a whole, because it now means that lenders can't withdraw their assets anymore. The pool is fully utilized. They've deposited their assets. You've borrowed all of them, and they can't withdraw until you go and redeposit those assets. If you change the slope of this line to make it very steep, then what you get is very low capital efficiency. If you make the cost of borrowing very expensive, then you'll avoid this problem of fully utilized pools, but you'll end up actually prohibiting borrowing so much that you get very low utilization and very low capital efficiency on the protocol. So this is again, it's on Compound. They've gone with a pragmatic approach to kind of explore what parameters work best for different assets over time, and they change these on fairly infrequent periods depending on what works well. But when you have hundreds of assets on a protocol and things are dynamically changing very quickly over time because you have illiquid assets with high volatility, you need an approach which limits which is able to adapt to changing conditions in real time without having to go back and keep changing the slope of this curve. And that's why we do something different on Euler. So this is how the system works on Euler. We still have this interest rate line here, which basically guides the interest rate during normal times. But during times of exceptional supply or exceptional demand for borrowing, we allow the interest rate to depart from this ordinary interest rate line and to actually increase or decrease above or below the line. And specifically how we do this is we first determine a target utilization ratio, which is something that is basically optimized to avoid low capital efficiency, but also avoid at the other extreme the risk that people can't withdraw their assets from the pool. And what happens is when the interest rate when the utilization ratio increases above this target interest rate, above this target utilization ratio, the interest rate slowly starts increasing over time above the ordinary curve there. And what this means is that borrowers are now paying more and more interest every single day, and which brings on board more supply because lenders are now looking at these juicy interest rates that they can get. And so strategies like YEarn that we talked about before are starting to send their bots our way and bring on board more supply. And similarly, some of these borrowers are sick of paying high interest rates, so they decide to exit the protocol and take their supply elsewhere, take their borrowing elsewhere where they can get better rates. And so what this means is that over time, the utilization ratio comes back down towards the towards the target here. And of course, on the flip side, we see the exact opposite happening. And generally, when you're close to this target utilization ratio, we use a control function basically to bring interest rates back towards this, back towards the ordinary line. And so what we see over time with the same kind of dynamics here is that you end up cycling, the interest rate ends up cycling around the crossover points of these two lines. And ultimately, this means for borrowers, they get better interest rates when there's low demand. And for suppliers, they get better interest rates when there's high demand. And importantly, we end up fixing the utilization ratio around an amount which is both capitally efficient and is safe for lenders. So it doesn't have this problem where they can't remove their supply. So yeah, I think that highlights to you just how creative you can become with these kind of protocols. You can bring on board ideas from fields from very different backgrounds and use them in use them in DeFi to improve how finance works. In this particular case, we're kind of relying on two effects here. So we have a bit of game theory determining what happens with lenders and borrowers when the interest rate spikes. And then we use a bit of control theory to basically guide the interest rates outside of exceptional periods. And that's all from me today. I just want to end by thanking the two societies who are hosting this. And of course, thank our investors who've been backing us and supporting us along the way, along this very exciting journey. Thank you very much.
Thanks, Michael, for a wonderful talk. Yeah, I think it was a great introduction to DeFi. Nice, clean, and clear. I guess any questions? If you have questions, please raise your hand or pop them in the chat. So please fire away. But if not, I'm happy to get things started. So one thing I wondered, Michael, was during the Encode Club hackathon, or maybe before, like, when did you come up with this idea to use control theory and apply it to Euler and lending rates?
That's a really good question. I'm not sure I can pinpoint exactly. I think I suspect it was earlier this year, maybe around earlier in 2020, maybe around March time, actually during lockdown. So maybe lockdown was the inspiration for this. I'm not sure. Obviously, I had nothing to do, so I was probably thinking about interest rates and how we can shape them in DeFi. Actually, I participated in an Encode hackathon in 2019 and never finished. So my wife and I had a baby, which kind of ended up distracting us a little bit, and so I never finished that. And then I had conversations with the Encode guys, and they encouraged me to go again in 2020 with another attempt. And it was around that time that that DeFi was really kicking off. Things were really picking up, and people were getting really excited about things like Uniswap and Compound. And obviously, I was using these protocols and thinking, I've always been thinking, my background in evolutionary biology, we learn a lot of different tricks on the theory side, and I always wondered whether there might be something I could use on the game theory side or the dynamical system side to bring to cryptocurrency, and this seemed like a perfect avenue to explore that. So that's really how it came about.
Awesome, really cool. One other thing that I was wondering was, what advice would you give to students who are at uni now and are like, oh, I hear about crypto, it sounds cool, but how do I get into it? Or I don't really know much, because it's not like you can go and take a blockchain course, in blockchain development at Oxford at the moment. So what advice would you give to them?
I would say a few things. I would say just get stuck in is the first thing. So there are lots of people on YouTube making great content at the moment. I mean, there's a lot of garbage as well. A lot of people just trying to promote get rich quick things, but there's also a lot of great technical content on there as well. So go and explore that, learn about these protocols, use a little bit of money to go and play around with them, and don't, try not to worry if you lose a little bit of money, but see how they work. And see why they're beneficial, and maybe try to find areas where things are not working as well as you'd hope. And but yeah, there's some great content providers out there. One guy that I really like, who I'll give a shout out to, is Eat the Blocks. So that guy, I've watched a lot of his videos in the past, and he covers a lot of the kind of basic coding stuff you need to get started in DeFi. And there's actually been some people out there that have created DeFi protocols that came into the space with very little background in computer science or in the space at all, but just through learning online, they've done really well. The other thing, of course, is we came through a hackathon, and I would really recommend people just get involved in those as well. They're quite low pressure. They can be really great fun. You can meet some great people. I actually met my co-founders on the hackathon back in 2020. You can learn a lot of skills just by going through those, and a lot of the organizers are very, very helpful. And oftentimes you'll find existing protocols are actually providing quite generous rewards and funding for people who have good ideas. So it can be very very worthwhile. I really recommend people get involved.
Sweet. We've got some questions popping into the chat. So Neil asks, DeFi is great, but getting into it isn't always straightforward or cheap. One has to purchase Ether on a centralized exchange, transfer to a decentralized exchange, and then purchase another token. So paying 3 times, and gas prices are high. This is true. They are very high at the moment. Yeah. It can cost over $30 to do all of this. Well, if you're getting it for $30, that's a deal, Neil, I got to say at the moment. Any advice on removing the series of costs? I don't know. I mean...
Yeah, I mean, it's not easy. It's not cheap. I mean, before all this, when I used to do a bit of trading, a couple of years back, and I used to do something terrible, which was to convert things into XRP before transferring them, because I knew it was quick and fairly cheap. So that used to be a quick and dirty way to move things between Coinbase and, say, Binance. But for DeFi, you're right, the gas costs are very high right now, and that's because there's a lot of excitement. And so if you're dealing with a small amount of capital, it can actually just eat away most of the capital in fees. So that's one thing that everybody in the space is talking about right now, is how to improve efficiency and lower gas costs. And so there's a lot of talk about what are called like layer 2's technologies, and I think we'll see a big explosion of those in usage of those in the next year. It's something we'll be looking at on Euler as well, because I appreciate it's not that easy. I've got friends asking me at the moment the same thing, like, how can I get involved in the space? And like you say, it's with gas prices as they are, it's just a pain, and they can't really see. It really puts people off because they can't see the all of the advantages that I've talked about in this talk here. They don't really see that if you're spending $50 on gas just to get in the system in the first place. So
yeah. We have, okay, so I guess here, we can combine these two, I think. So Mo asks, well, he says, great stuff, great presentation. What are some of the current limitations of Euler? And then Tarek also says, good presentation. So what about the risk using Euler as well?
Okay. Limitations of Euler, I think there are when you offer, well, they kind of come, like, the two questions are actually kind of linked, really, because a lot of it comes down to excess risk with these kind of long tail assets. When you want to offer lending and borrowing for things that are very volatile, you have to put certain restrictions on, which unfortunately limit capital efficiency. So in an ideal world, you'd have like lots, very large pools which were all integrated. But when you have these kind of assets, you have to isolate things, most of the time, at least initially when they're first listed on the protocol. And so that's one thing I'd really like to get rid of, is the need for governance in making some of these decisions. When you first list an asset on Euler, it will come with what's called the zero collateral factor, which will effectively mean you can't use that asset to borrow other things. You can deposit it and start earning interest from it, but you will have to go through governance to persuade people that that token is legitimate and is worth something, so that people can then borrow against it, that you can use it for borrowing. And so I think that's the need for governance there is always something people who are making these protocols want to remove, because as soon as you have governance, you increase centralization, and that's a big limitation, I think, of this kind of approach. On the risk side, we do just so many things to try to combat the excessive risk. So, one of the big things is, when you list new assets on the protocol, is that they enter in these kind of isolation modes where they, don't harm the protocol as a whole at that point. Users can interact with that pool, but they can't actually, they can't use it to exploit other pools. We also have lots of innovations around how liquidations work on Euler. So for those of you that know how Compound and Aave and other protocols work, sometimes users can get to a point where their kind of borrowing has become unhealthy. So the amount that they've borrowed is starting to approach the amount that they've actually deposited as collateral on the protocol. And in this instance, you want to basically liquidate them to make sure that they never get to a position of insolvency where they've got no incentive to pay back their loans. And so, we've been quite creative with how liquidations work on Euler. We use a kind of auction mechanism to process liquidations. We have this dynamic system that we talk about as well. So, there's lots of areas where we've innovated on the risk side. Which are probably too technical to get into too many of the details about right here, to be honest. But very happy to explain them to people. If anybody wants to come and ask questions after this and see how things work in more detail, we've got a Discord and a Telegram channel where people can pop in and ask questions. I'm more than happy to explain things on there.
Yeah, definitely join the Discord and the Telegram if you're interested. So, okay, now the questions are coming through thick and fast now. So Jan says, really interesting talk. Thanks a lot. I'm definitely not an expert on smart contract development, but what are your thoughts on the security of the protocols underlying DeFi projects like Uniswap? Could you see a repeat of the DAO heist in 2017, or what things have happened in the community since then, which would prevent a total loss or jeopardization of funds?
So I mean, in DeFi, there's been a lot of hacks, and I think this is partly because people have rushed to get out whilst the market's hot and haven't gone through the proper safeguards to make these things work. So securing code audits is really important, and I think in terms of what's changed since then, I think code auditing has improved dramatically. We see lots of firms offering these services now that weren't around at the time, and that expectation is there now. You can't really go out and release a serious protocol without getting proper audits. If you look at, I think it was Compound or Aave. They have 4 or 5 different code auditing firms going over their code already. And they do these on a regular basis. So anything new that comes up, any new sort of trick that hackers are using, will hopefully be caught before things get too bad. The other thing is that people are because of the high profile nature of these, people are now offering bug bounties, and this will be something we do on Euler as well. And a lot of the time, these can be quite generous, and they can be quite rewarding for hackers who are ethically minded. If you're chasing something down for a bug bounty, you end up getting a nice cash reward, and often a lot of sort of kudos in the community as well for doing this. Whereas if you decide to run off with users' funds, you then have to figure out how you're going to actually turn those back into cash, which can be quite difficult, and you run serious risks of being caught, by the police and things. So I think that's also changed as well. The culture around that. Is helping things along. But the key thing is that DeFi protocols need to take risks seriously, and at Euler we're trying to avoid rushing things too much and getting things out just so that we can announce ourselves to the public. We've spent several months now just in kind of solitude, working away and doing thorough testing of the protocol to make sure that we hopefully don't face these kind of problems.
Yeah. I can imagine there's quite a bit of a responsibility. With great power comes great responsibility. So Jonas asks, this is an interesting question: is there a risk that overly complicated protocols, for example, like on Yearn, can lead to bubbles, or do you believe that the decentralized nature prevents that?
Bubbles in terms of inflated prices and things.
Yeah, I'd imagine. Yeah.
I don't know why, complexity in and of itself would drive a kind of bubble. I mean, the bubble, whether or not it's a bubble right now is always hard to say until something pops, I guess. What I've learned over the past few years is that I'm very bad at predicting markets. So I don't want to claim this is necessarily a bubble, because a bubble implies it will inevitably pop, and that's not necessarily true. I think DeFi is very different. What's happening with DeFi right now is very different to what we saw with the ICO bubble. In the ICO boom, people were raising like 30, 40, $50 million for a white paper. And in DeFi, that's not happening. The YN guys didn't even have an ICO, and they've been very successful because their protocol is very, very useful for people in generating things. So there's a better fit now between what the market is wanting and what's being delivered, really. So as for complexity itself, I think you have to take that into account as a user when using these things. So like YN, if you see a really complicated strategy that's delivering 300% APY, then you have to weigh up the risks as a user and decide whether that's for you or not. It probably is the case that the more complex things get, the bigger the risks are that something goes wrong and your funds get locked somewhere, or somebody rug pulls or whatever. I think generally just urge people to sort of hedge against this kind of stuff and balance their risks. So it's generally the case that those kind of percentages aren't sustainable long term. So people just need to be careful and take those things into account.
Thanks for that. That was I think that was a good way of putting it, because it's still evolving, isn't it? This whole space, and it's evolving very rapidly. So James asks, do you think that AMMs, I assume that's alternative money markets or alt money markets, will ever be able to compete with traditional market makers, liquidity providers, within the context of traditional finance markets such as the NASDAQ or the FTSE?
I mean, I would say yes, actually. I mean, we're already seeing Uniswap did 30 billion worth of volume in January, which is insane. Especially given the gas prices we've got now. If you took away the gas prices and so that all these people that we said can come on board and try this and explore, then they would have done much more than that. The reason I think it's possible is that I am very excited about DeFi generally, and I think we will start to see more traditional finance types coming into the space as well. And we have a lot of developments around synthetic assets, so bringing on board stuff off chain and putting it on chain. This isn't all just about ERC20 tokens for other DeFi protocols and sort of crypto assets. There's going to be a huge explosion in the near future, I think, of more like things like stocks and shares, other types of financial products coming onto Ethereum, and that's only going to increase volumes even more. So absolutely, I think it's possible.
Yeah, just to clarify, that's AMMs is automated market makers. Thanks, James, for letting me know privately. So then I think just a few clarification points here. So Rosalie says, so if a money launderer decides to lend some DAI into the Euler pool and the police asks you to block this, can you do so? Would you want to do this? So we're getting into the ethical side and actually the powers that, what do you hold as a blockchain?
No, the answer is no. We wouldn't be able to stop them doing that, and that's the nature of permissionless. So I won't pretend that doesn't sound terrible. I think that scares a lot of people, but with regulations on the one hand can protect people, but they can also massively punish people. So we've got all these regulations now around traditional financial markets, and they are, in some sense they do protect people, but in other senses they don't at all. They're like, basically concentrating capital in the hands of a very few, small number of people who have gained an awful lot of power and are also sitting in decision-making roles and setting those regulations. and which enables them to make even more capital and gain even more power. And so we've really concentrated things in the hands of a few, and I don't think that's benefiting ordinary people. It's very difficult for ordinary people to go out and invest in companies at an early stage, which is very easy to do in early stage DeFi projects. So there are all these other costs that we don't think about. So I realize that, yeah, stopping money launderers and things is a very noble pursuit. But when you implement regulations which stop that, you have to recognize that they also hurt people in other ways too. And so in DeFi, everything goes in some respect, and that comes with big advantages and also some challenges. But I wouldn't have it any other way. I wouldn't want to make it so that we could stop those money launderers. It's deciding what's a prudent use of funds and what's a legal use of funds is also can be also really subjective. For instance, I gave the example before about the pro-democracy people in Hong Kong. Are we happy that they can have their assets frozen? Would we let them use their assets in order to sort of store them and earn some interest? Well, I'd probably be quite happy to do that, but there would be other people that argue, no, they shouldn't be allowed to do that. Let's take those assets and freeze them. So I think legality around how people use their money is also can be really tricky to define, although the example you gave there seems really obvious that you shouldn't be allowed to do that. But I wouldn't have it any other way, to be honest.
Yeah, I think this is definitely a question that blockchain has really opened up because of its permissionless nature. For the first time, people have all of a sudden been able to be their own bank and decide their own, money laundering rules if they really want to, kind of. But even then, it's hard to vet everyone who takes part in the protocol, if not impossible. And Neil asked a question. This is something I wondered when I was first introduced to DeFi, and I'm sure you'll give a great answer to this. So if someone needs to deposit, over 100% of the loan value, so it's over collateralized, then, they already have some funds. So essentially, what are they going to do? What are people going to do with the crypto that they borrow?
Yeah. Well, it depends on the assets you're lending and borrowing. But let's say you own some crypto, and you want to hold on to it because you like crypto and all the features it offers. Let's say you hold some Bitcoin. So you could deposit some of that Bitcoin into a lending protocol, take out a stable coin. You could then go and use that to trade while still holding on to your existing assets. You could use it to exit the markets altogether, take that off chain, turn it into cold hard cash, pay some rent or whatever it is you want to do in your real life. And then come back and get your Bitcoin back later when you're more liquid off chain. One of the big things that people are using lending and borrowing services for is to take on leverage. So you can take long and short positions by lending and borrowing. For instance, in borrowing, when you borrow an asset, you are basically taking a short position in the market. You would go away, borrow the asset, then sell it on the market, and then buy it back at a cheaper price later and return it, and then you would have taken advantage of the difference in price to profit. But you can also leverage up, so you can deposit some DAI with a collateral, deposit some Ethereum with a collateral factor of say 0.9, borrow some DAI, go take that DAI, buy some more Ethereum, deposit the Ethereum, get some DAI. Keep doing that a few times and you've leveraged up basically, so you can take leverage positions in the market. People are also borrowing assets now to participate in governance decisions. So you can go away and borrow, say, the token for Compound or Uniswap or whatever, and participate in their governance forums. So that's an extra use case for these things. So yeah, there are lots of different ways, lots of reasons why you might want to borrow these things.
I think I'm conscious of time, so I guess there's totally follows up well. What are the main disadvantages of permission networks? Might they not be a bridge between new and traditional finance worlds, such as like the Libra or DM coin that Facebook's planning to release?
Okay, yeah. Well, let me just answer a slightly different question about what's useful with kind of off-chain and like traditional finance. So one area, most of the stuff I've talked about today is over collateralized lending, and in a lot of markets, in traditional finance, you have more typical loans where you basically take out a loan based on a contract between you and a borrower. And we're seeing some really nice innovations in the space between Aave, who are another permissionless lending protocol, and people, I think they're called open law. People are basically drawing up contracts that then can be put on chain and allow people to sort of interact and take on debt in a kind of delegated way. So you can delegate your borrowing capacity to somebody else who can then borrow it, and you then have more of a trustful kind of off-chain relationship based on some kind of contract. And so I think that's one really cool area where there is this bridge developing between the traditional world of finance and the kind of on-chain decentralized form we're seeing here. But in terms of these permission networks, I'm not really sure I see the advantage of them, to be honest. Why not just use a database if you're going to use a permission network? It seems kind of pointless to me. I'm sure it will attract some investors and people will get excited about it, but it seems to me more like the traditional tech firms have seen that there's this exciting thing going on in the space and they want a slice of the pie, and they're already a bit late to the party, so they're now trying to create their own networks. But I just don't see the point in them. So it's hard to say whether I think there's any advantage of like bridging things that way. I would say not, probably.
Yeah. Once again, I guess, I think that's it all for now. And thanks for that answer, Michael. And thanks for like a great presentation. There's tons of messages in the chat from people who've absolutely loved it. So yeah, once again, thanks for taking your time to give the presentation. Also want to thank our co-hosts, the Fintech and Legal Tech Society. But yeah, once again, also thanks for being a great audience, like some really interesting questions from a broad range of experiences in the crypto space and background. But yeah, so that is it from us. We've got another event coming up, I think, on the 18th of February, I believe, and that's more of a trading themed event if people are into that and want to learn about crypto prices and thoughts on why they're rising, thoughts on why they're going down. Are we really in a bubble? I tell you now, it's not investment advice, but I would say it's definitely worth investing time to learn about this space, as we've seen with Michael and his amazing project, Euler. So once again, Michael, thank you so much. It's been a pleasure having you here.
Thanks for having me. I really enjoyed it. Thanks for all the great questions as well.
And hopefully, we can have you back again soon. Maybe not virtually next time. Bring you back to Oxford.
Definitely, yeah. I'd love to come back and just see people in the flesh.
Cool. But bye for now.
Thanks a lot.
And enjoy the rest of your evening.
Thank you. You too.